Restoration contractors want to run profitable businesses, and you're driven by passion for helping others. If helping people wasn't part of your DNA, you wouldn't get up at 2 in the morning or travel 1,000 miles to help people in need. You do these amazing things and want to turn profits along the way. For many restorers, finding profits in the business has become harder and harder. And it's no surprise. Insurance companies are getting further from the claim, and they're using outside resources to manage costs. TPAs, consultants, and reviewers are working hard to remove dollars from your estimates. Even the estimating systems are not in your favor of generating profits. Some days it feels like your business bleeds cash. You're constantly paying for staff, paying trades, paying rent, and looking to find those profits in your company. You might even ask yourself if staying in business is worth it. It might be easier to walk away and sell t-shirts on a beach or something, but feeling like this is wrong, and you shouldn't have to feel that way. You have a business that is in high demand, and people count on you to help them at their time of need when they have an emergency in their property. Now, I've managed businesses and own my own shop, and I know how it feels to lay in bed, staring at the ceiling, praying that the mailman shows up with a check just so that I can make payroll. But I also had the pleasure of meeting my accountant to figure out how to get the money out of the company. The best part of having challenges thrown at you is that you become stronger because of it, and it helps increase your tolerance to deal with more challenges. Now, if you're a restorer who's busy and you don't seem to have the bandwidth to take on another big project, you're probably right. And I'm going to show you how to focus on 3 areas so that your company can pick up the points, find profitability, and change how your business works to make it easier and more efficient to run. Now, these are small changes that you can tackle daily, weekly, or monthly. You can focus on charging out more dollars or finding places that you can save money. And finally, we're going to talk about increasing your volume. Now, I want you to work through a tool that I used, and I want to share it with you. I want you to be able to figure out where you are, figure out where you're going, and look at how those small changes can really impact your business. Every business is more fun to run when you're making money. So to understand where a business opportunity exists, we need to focus on where the money in your company goes. We have a major spending area that is generally called cost of goods sold. This makes up your wages, materials, and costs associated with the job. Now, some accounting systems will move this around, but generally this is where it's going to be located. Now, the next place that we focus is overheads, and there's 2 types. There's variable and fixed overheads. Fixed expenses are things like your shop, your heat, your utilities. Variables will be something like your marketing or admin assistants and other costs that increase as you scale the business and as you increase your business. For this discussion, I'm lumping them all together, and I'm just going to call them overheads. Now, there's one more overhead that only some of you will be paying, and that's royalties. Now, here's the interesting fact. If you are paying them as a franchise, or even if you're an independent contractor, your net profits will not be vastly different. Those who are paying royalties take money off the top of your sales, and that goes to support the mothership. For those of you who don't have royalties, your expenses show up as consulting, advertising, and marketing. So as a general rule, they cancel out. But if you're an independent business, you do have the opportunity to outperform the franchises due to being able to outperform the royalty costs. Now, no business has ever said, wow, we had such a hard year, we made too much money. Unfortunately, this last section is the smallest section. This is the amount of profit that we're generating in the company. And this is where we want to be focused. So it seems simple, but let's look at reducing costs. Remember, our business spends most of the money that comes into the company on costs and very little of its profits. So we have cost of goods sold, fixed and variable costs, but the question is, where do you focus your time and energy? And the costs are broken down into a few categories. Now, some costs are investments and others are sunk costs. Marketing and staff are beneficial to the business, so I don't consider these as areas I cut. These are where I look at them as investment costs, and I typically don't want to cut there. These drive profits, they drive customer engagement, and they drive the business. Things like vehicles, they don't make up enough of a cost to make a decision change for me. Even if you have a large fleet, they only represent a small portion of your expenses. But what you should focus on is getting the best vehicles to deliver the gear and people to the job. You want these to drive efficiency. No pun intended, but you're trying to drive the efficiency into your business. However, the next areas are important. Trades come and go, and while they're worth you, they're your partner and a very strategic partner. However, we're considered a volume buyer. Even if you're a smaller shop, you still purchase large quantities of sub-trade services. In exchange for quicker payments, more volume, ease of paperwork, or a higher percentage of closing for those jobs for your trades, you can expect to achieve savings of 2 to 5%. And depending on the market and how you frame the relationship, you should be able to save that money. In some markets, more than others. Now, when times are booming and you've got a lot of new builds, it's harder to save larger numbers with your subtrades because they're in demand. But in 15 years, I've never not been able to save some money through negotiating with trades before we award the job. Now, materials are my favorite place to negotiate. They don't walk off the job, they are strictly a commodity, and therefore I shop these hard. Now, you'll want to set up an annual deal for your normal purchases. Get 5, 10, 15% discount off the retail cost. However, when I have larger jobs and you have to have a material list that I'm going to provide the retailers, I'm expecting that they're going to bid on these materials. And saving any percentages on these materials don't hurt your company from being competitive. So this is a great place to shop hard and save money. This means if you save 5 or 15% in savings, it might add 2 to 4% to your net profit. And that's fairly large when you consider the overall impact to your business. Equipment is more strategic. Do you buy, rent, and how do you maintain your equipment? Now, equipment is purchased without much planning in this industry, and it takes 8 to 20 days to pay it off. I've owned many pieces of one-time used equipment that actually cost me more than I made in the job, and I had to sell it at a deep discount. Now, this sat on my shelf, it took up space, and it ate away at my cash flow. You need to have a capital expenditure budget that if you have an event that you need to buy equipment, you move money from the budget into the expense early. But it's not something that you can do or just add to your business without hurting your business. So you have to put some effort into this. If you do this, you can save 2 to 3% in picking up your equipment purchases in the right time. Now, another area is mistakes or chargebacks for things that you didn't do. And restorers who do not document jobs at the beginning of the job for pre-existing conditions will inevitably pay for structural damages, contents damages that you and your team didn't actually do. Now, when we look at this, you're paying on average between 0.5 and 2% of your revenue to these claims. That's a large amount of money that's being spent out of your bottom line. And if you look at it, you might not see this because the likelihood is it's buried in job costs, deficiencies, and other buckets that you probably aren't measuring. Now, I used to watch a bucket that we called warranty work. And what I noticed is that these costs never made it to warranty work. Therefore, in my old companies, we lost track of a lot of these things. Finally, you have overheads. And when I say overheads, I'm talking about the staff that you can utilize and technology that will increase their productivity. We do that by getting system administrators to work on information from the field that can be entered into the office systems, and it allows us to complete and close our files faster. But what do you spend on administration? Imagine getting 20 to 30% of your revenue to be able to increase that with the current expenses. Not adding that 20 or 30% more work to their day, but making the work more productive. What is that worth to you? If your overheads are 35% today, and you have a reduction of 20 to 30% for our administration time, cost of PMs, owners, and our admin staff, that means that you can lower your overall cost by anywhere between 3 and 5% when we increase our volumes. That's a dramatic savings, and that goes right to your bottom line. It also makes your staff happier because they're not chasing things that they should have seen in the file in the first place. When we look at our costs being reduced, imagine if you could restrict your costs down to 3 or 8% of what they are currently. For some companies, that increases your profit, and for others, it might double or even triple your profit. This results in $30 to $80 for every $1,000 you spend. Can you save that kind of money? Could I pay a trade $30 less per thousand or $100 less per thousand? What about charging a little bit more? And that takes us to the next section, which is increasing our charge outs that are hard for accountants and financial analysis to be able to pick up. These show up as my staff take too long, they're always slower than what I estimated, the materials came in high. We can never make enough money on a job. And you might see this as a project manager when you compare one that has less margin against another project manager doing the same book of business or doing the same work. And I don't mean when a program rule set impacts your job profits. This is when you have something that you have to look at and then evaluate, is your program work delivering for you? And how much does it actually cost you? But when I look at profitability, I'm looking at how much can the business generate in small amounts of additional revenue. This is different from volume because we're looking at increasing the revenue on each job. But businesses who look at the charge outs, they have to look at them as opportunities for charging for process and procedures that are justifying and supporting your actions. Now, there are some areas where restorers should be looking to justify charge outs for each action and increase your actions to comply with the law or regulations. So a lot of contractors don't look at the OSHA laws, municipal, state, and federal, and they're very powerful tools that provide you the support and justification you need. What power does following the law and regulation provide when a reviewer says that they don't believe you should have done it or that you even needed to follow it or comply? Now, how well do you scope your jobs? Because we rush from one job to another due to the increase in compliance with the insurance company's requirements, but we rush through scope and we leave money on the table. And when you miss scope, you technically reduce your own charge out. You increase your costs and you negatively impact your bottom line while increasing your risk. Now, the best time to create a scope is when you're on site and you can review the space, make judgments about time and the effort it's going to take to do the work. And regardless of the estimating system that you're using, you want to capture your scope. And when scope increases due to additions in price, changes in schedule, or changes that are after the initial scope, these change orders should be implemented. Now, often project managers report not doing a change order for $500 or less because the paperwork and the approvals are not worth the effort. Administrative process and pain points reduce the likelihood that it'll be charged for. And that's the reason I don't focus on cutting staff. It's because they control the amount of equipment and the scope that we charge for. I'd rather invest in staff and support them so I can expect them to learn their craft and get good at what they do. Equipment, materials, processes, and compliance with the laws does not get on the job site by themselves. You need trained staff, experienced staff, and people who know the industry and the expectations that come with being in this business. Turnover is a killer of profits, and losing people who know when and where to put equipment on the job site reduces your capabilities and opportunity to make money. Now, less experienced staff typically undersize the equipment that you have on your jobs, and this means longer run times and less money being charged out. Imagine if you sized your job properly and maximized your rental income while doing the right thing for your client. You would incur more revenue that should be paid for. Being reactive to jobs and not sizing them or not taking a proactive approach is a surefire way to lower your margins. What profits are you leaving on the table? Do you think you can charge $100, $200, $500, or $1,000 per job? Now calculate that on 50, 200, or 500 jobs. It adds up to substantial amounts of profit that your accountant cannot see. This is not volume. This is margin. Increasing the size of the job and the charge out is all about profitability on the job. So we talked about lowering costs and increasing charge outs. Now we run into volume. Typically, companies make this play too early. I was guilty of doing it myself when I wasn't ready to scale the business. The foundation and fundamentals were missing, and therefore it becomes really difficult to scale, and it makes the business hard to be profitable. We generally talk about building a low margin, high volume play. But what you need to know is that companies that actually do this in the real world, they're not companies built like restorers. Low margin, high volume players control everything in their business. Distribution channels, they control their end-to-end supply and delivery. They even own their own customer. Walmart, IKEA, and Costco are perfect examples of this, where they control the environment and the products that they sell. The restoration environment is not predictable, and you cannot control the transportation efficiency, route optimization, and all the other things that go into becoming effective. This doesn't mean that there aren't restorers who have size, geographical reach, or volume to be able to make the play work for them, But if you're a smaller location with only one shop, you have to have the deep pockets to be able to take on the low volumes, and your margins need to be modest to high in order to grow and expand. When you take these principles and apply them to your business, you can impact profit from all angles. I'm going to take you on a tour of this tool that I talked about earlier and walk you through how to figure out where you are, where you're going, and where you want to be. Now, this is a workbook that I use to figure out how to gauge my success in measuring these three areas. First, you have to know how much revenue you're doing. For this example, I'm going to use $3 million. Now, let's say that you do it at a 7% net profit a year. This shows you that you're earning around $210,000 in positive profits. I click on the next tab. I enter cost controls, the impact of cost savings on your business. In my presentation, we talked about saving anywhere between 3 and 8%. I'm going to leave it at 3%. I don't want to come off greedy, but you really should be shooting for somewhere between 5 and 8%. If we do 3%, we add another $90,000 to increase our profit, or add 43% to our profit. This is massive. To put this into perspective, for you to make $90,000 in your business doing exactly what you're doing today, you have to generate another $1.285 million. You need to increase your business size by 43%. Now, I can tell you there's very few people who can grow their capacity that quickly in a normal year. The next tab is increasing your charge out. When we talk about increasing charges, we talked about justifying your estimates using standards, using change orders, and properly sizing your job. If I add just one air mover to the job for 3 or 4 days, I'm adding $100 to $150 to the job. Can I add a power box, lock boxes, blinds, site protection, PPE, decontamination of equipment? Yeah, I can, and so can you. Charging $50 per $1,000, it's actually not that hard. $50. That's all it takes to change your business. And how much time would it take you on each job to look for that extra $50 per $1,000? That's the same as going out and trying to find $2.1 million of new business. Come on, guys, you're beating yourselves up. I won't say it's easy, but it's the little things that you can do that will make a real difference in turning your business around. With those two changes, if we go and look at it, in order to make a 15% net profit, we have to more than double our business. And you know what's exciting here? Now that you know what you're doing on the cost side and charge out side, you're now ready to increase your volume and make some real money. When we increase our business by 25 or 20%, we're not looking to shoot at 50% or 100%, just 25% and see what happens. Now grow your business, make your profits, and what are you doing? You just increased the value of your business and your asset value of the entire package. Your business is easier to turn around and get profitable, and all you have to do is put a little bit more energy into running the right parts of your business. Regardless of the size of your company, every business can do the small changes across the organization that drives real impact to your bottom line without burning out your staff, and worse, without causing you to throw in the towel. Now, I show you the impact that small changes could have to a $3 million business. And we've already established that you are an essential business to your community. So my advice is aim small and miss small with these changes that you can focus on. There's 5 things that you can do today to get the most out of PSA and Encircle that'll absolutely be a game changer for you. 1, reduce the cost by negotiations with your trades, your suppliers, and stop those dollars from slipping out of your business. 2, prevent unnecessary chargebacks. Don't get caught subsidizing the deductible for the homeowner. Document those pre-existing conditions. 3, use digital scoping tools in the field to prevent losing dollars. This allows you to charge for the entire scope of work. 4, you want to use that technology to size your water damage jobs and justify your equipment rentals. And 5, implement great technology that helps you get more from your variable and fixed costs. If you have PSA in the office and you have Encircle in the field, you're gearing your business up for the most efficient systems to deliver control over your entire business. With so many choices and so many distractions in the software, how can you figure this out? You're already using PSA in the office to help run your business, and some of the choices have already been eliminated for you. But you really need to get the most out of your PSA system, and you need to maximize your efficiency by not chasing the paper in the field or trying to find information that you should have at your fingertips. Let's face it, technology that works well makes you more money and makes it easier to run your business. Now it's time to unleash the power of Encircle to streamline your field where the majority of your staff and trades work. And the field is where you make and lose your money, and you can't have fractured systems that allow the money to slip through the gaps. Now imagine your company having systems that are simple and easy to use that connect together to give you a much easier company to run. We are extremely excited to have the integration with PSA and technology companies working together so that you can do your job of helping people in need. Take control of your company today, book a demo with our team, and see how Encircle can help you find those missing profits. And before we take your questions, I just want to share with you one of our passionate customers who took the time out of his vacation to share his view from an owner's perspective. And I want to introduce you to Justin from Alliance DKI.
One of the benefits of being on vacation and in recharge mode is being able to log into the Encircle app and check on progress on meaningful projects, that frankly, all projects that are going on in my absence in my organization. Alliance Disaster Cleanup relies heavily upon Encircle and the information. This product is not just for adjusters or clients or for coworkers or employees. It's for owners as well to have the wherewithal, the quick wherewithal at the click of an app to see how progress is being achieved on projects that are meaningful to the relationships that I spend every single day trying to develop and foster. I want to thank the people at Encircle for the degree of thoroughness with respect to the training. We could not be doing this without you. Having this tool is excellent.
And I'm really happy that he took the time out of his vacation to give a little testimonial for us. But I'm going to be here as long as they'll let me stick around so that we can answer your questions. If there's any questions that you don't have answered or that you want to do offline, you can email us at marketing@encircleapp.com. Thank you for sticking around for the presentation, and I'll start answering those questions.